Is the Fed about to choose jobs over fighting inflation? And what does that mean for your money? DoubleLine's Jeffrey Gundlach breaks down why Fed Chair Jerome Powell is signaling a wait-and-see approach, even as inflation risks are rising again. If you want to understand the real risks and opportunities ahead, you won't want to miss his expert analysis.
This time around, last time it was sort of like, we don't know anything, which doesn't sound very good. And this time it was sort of a wait and see. And we're getting to a point, I've talked about this at the meetings all year, where we started the year in January with the Fed saying, we're in a great place, because everything was kind of going their way. And now with the adjustments to the SEP in March and now today, they're kind of incrementally moving in the wrong direction. You know, inflation has come down, but as you just referenced, Jay Powell knows, just like everybody I think knows, that there's upside risk to inflation numbers. And meanwhile, the unemployment rate, while it's pretty well contained, there's some very worthwhile, not high frequency, but long-term indicators that are worrisome on the unemployment rate going higher. On the inflation side, you basically know that the base effects, meaning the numbers that are rolling off from a year ago, are very low numbers. On the CPI, there's a 0 and a 0.1 rolling off the next 2 months. So those will probably be replaced with numbers that are higher than that. And so the Fed knows the inflation rate is going to be probably worse at the next meeting and perhaps also at year end. So they upgraded their inflation forecast. The three things, you know, you got the base effect I just said. You also have oil, which is up. Obviously, it could be a short-term spike based on tensions, but it's up over $10. It's up 20%. And every $10 that crude oil goes up, if it's sustained, adds about 0.4 to the headline CPI. So we've got the base effect, probably going to add a couple tenths to CPI. We've got crude oil, if it sticks, maybe adding 4 tenths between now and year end. And then you've got the tariffs, of course, which are very unknown. And one thing that's clear from Powell's answers to the questions is he thinks tariffs are inflationary. There's all kinds of arguments that it might slow down, you know, destroy demand, slow down the economy and all that. But it's basically, he believes it's inflationary, someone has to pay it. And that might mean that margins could be incrementally lowered. And of course, we've seen earnings estimates go down moderately for this year. So the mandate keeps getting, the dual mandate keeps running into increasing tensions. And at one point, that's why I think he said wait and see. At some point, one of these dual mandates is going to win out over the other one. And I think, and they're going to have to pick one. And I think they will pick the fighting the rise in unemployment more than fighting the rise in inflation. It seems like we're being prepared for higher inflation numbers that are very likely to happen. And he talks about maybe there's a one-time effect from tariffs and that dissipates in 2026, but maybe it won't. And so we'll have to see what happens with that. But in the bond market, what we've seen is a steepening yield curve. We've seen long rates going up substantially more than short-term interest rates, which is the bond market's way, in my view, of taking sides and saying, it looks to me like they're going to say, we're going to cut rates, even though inflation is probably higher than 3% between now and year end. And so if the unemployment rate goes up, they're probably going to be more likely to cut rates, even if the inflation rate's at 3.5%. The two indicators that I'm really focusing on for the employment rate is the yield curve, of course, has steepened and de-inverted. And the indicator that I think is the most valuable is the 1-year moving average of the 2s, 10s yield curve. Because when it goes positive on a 12-month moving average basis, that's, for the past 35 years, that's been right at the front end of a recession. And it is above now its 12-month moving average. So we're going to monitor that very carefully in the months ahead. The other thing is the U3 unemployment rate, which is at 4.2% now, versus its 36-month or 3-year moving average. And when that crosses above its 3-year moving average, going back all the way to 1990, so 35 years, you've seen that right when it crosses above, you're at the front end of a recession. And that has already happened, but it's not yet it's not accelerating. In the past, when it goes above 36-month moving average, it accelerates. That has not happened yet. And so what we're watching very carefully is the continuing claims, which have been rising for the last 2 years, and they foreshadowed the moderate increase we've had so far in the U3 unemployment rate. But continuing claims keep rising. And so we're going to be watching that on a real-time basis, because if that continues to move higher, it strongly suggests to me the unemployment rate will be moving higher. Also, one thing I want to point out is poor Jerome Powell has been dealing with 5 years of incredibly unusual data. You know, the money printing, and then the surge in the bottle chain, the supply chain problems, and then the reversal of all of that. And now we have these tariffs, and now we have all these tensions in the Middle East affecting the most important commodity for inflation, which is oil. So I understand his wait and see approach, but in the end of the day, I'm just trying to divine the meaning of the bond market. I think we believe that they're going to be more likely to cut interest rates even against a rising CPI or PCE as we move forward through the end of this year and into 2026. And so I believe that this yield curve steepening is a trend that has been in place for a while now, and I think it's going to continue with the Fed likely to keep pressure lower on short-term interest rates. I do think it's interesting that there is no talk whatsoever of a hike. I thought there were some questions in the Q&A that were relevant to that point, but it's clear that everyone on the Fed thinks that the next move in rates is lower. And that further corroborates my idea that ultimately when the mandate comes into tension, they're going to look for to improve employment rather than to fight inflation, as long as it's moderately above 3% only. So that's kind of my takeaway for the meeting. Not a lot of new information, but it is a very, very lot of moving parts going on with economic data and tariffs and war. I mean, what else can you throw into that equation other than some sort of natural disaster?